Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris rapeseed, Winnipeg canola, and Malaysian palm oil.
Paris rapeseed. 17 weeks ago, I detailed some key bearish pressures that the market had back then started dealing with. The reason I repeat them now is because the levels have once again become significant. They were, and I quote, "We have overhead a more diaphanous congestion band between 456 3/4 to 468 3/4, a band that was relatively easier to navigate than the others mentioned, but which now has three key potential bearish pressures within it. They are the declining short medium moving average, which is currently at 428 and outside of it. Then the medium moving average, currently at 433.5, that's also likewise. And a declining long moving average, currently 446 3/4, which is just above it. Well, actually, still within it, actually. At least two out of these three are descending to impact the market, and one should not take away anything from them, especially any efforts to pressure the market from above, end of quote. Moving now back to today. In early March, the market punched up from below, through and over both the short medium and the medium moving averages, up through key overhead congestion mentioned in earlier commentaries between 438 to 445 3/4, through the gold colored flatlining long moving average currently at 446 3/4, and peaking and closing, though only the once, this week over the significant 50% Fibonacci line of the May to July 2023 move at 456.5, before gapping lower and resting on the gold colored long moving average and the top of the 438 to 445 3/4 congestion. Now, I also added the following comments 3 weeks ago, and I quote, "We have seen a turn towards the bullish with a move up and test of not only the upper time, but the green short medium moving average that is supposedly reinforcing. This is not a major turn, not yet, but it is not far away from being one. If we do turn higher properly, and the first key level is not far away at the February high at 427 even, well, we could see significant recovery higher and proof yet again that the two alternate necklines still have what it takes to turn prices higher." The reason I say 427 even is that any move over that level would set up the opportunity for a possible double bottom over mid-January to date period. So watch what happens up at the green short medium moving average, the 427 level, and the medium moving average overhead. End of quote. Well, we have formed a double bottom, and so I laid out 2 weeks ago some potentials for the move higher. Thus, and I quote, "A secondary harder to reach target for the recent double bottom pattern would be in the 446.5 area. The primary target has already been achieved for the break above the bearish shift pitchfork. Now, this pitchfork has been retired now. The secondary harder to achieve target X1 is in the 446 3/4 area." End of quote. Both these targets, so the old target X and target X1, have been achieved. The question now is what's next? Well, these pattern targets and resistances sit within the larger, more recent November to mid-December 2023 congestion band that stretches from the June 2013 high at 438 even up to the 50% Fibonacci line of the May to July 2023 move up at 456.5. I said about this congestion 2 weeks ago, and I quote, "The action lower this year has potentially more ammunition, enough to take on a substantial but smaller overhead resistance should it choose to." End of quote. So it all comes down to this. Does the market have the will, after achieving so much, to take things higher. Today, I am not so sure, not yet. I am waiting indications on what may happen next. Winnipeg canola. What I consider, or let me rephrase this, what I had in the past considered to be the most important recent pattern here was the late August to mid-November 2023 bearish shift pitchfork. You could also throw in some past patterns such as a short medium moving average, currently at 615.80, which is highlighted in green on my daily chart, as well as the combination of the October to November reverse head and shoulders continuation pattern. There was also an ascending triangle. This was not the best looking version of such a pattern, but it nevertheless still worked at the time. The bearish pitchfork had been excellent at showing the bearish angle of attack of this market since its inception in November last year. Really, until only 3 weeks ago, that's when it stopped. So what had we in the way below lower that slowed, halted and eventually turned prices higher? Well, looking at it, not much. It seems the approach to the December 2020 low at 567 even was the thing that finally turned prices higher, or more specifically the approach of the middle time support towards this 2020 low. So what did we have in the way topside that is now support, and what is still resistance? Well, there was the May 2023 low at 611.10, which was good enough support the market in January, and then the 2021 low at 629.60, which interestingly is acting as a support today. I had also previously mentioned the descending short medium moving average, which turned out to be of little effect. And beyond that, the mauve highlighted medium moving average, currently at 434.10. Of those four, 3 resistances have been converted into supports, leaving just the mauve colored medium moving average, which has become resistance once more. And to be honest, as resistance, it has been riddled like a Swiss cheese. So, 2 weeks ago I said, and I quote, "It's timely to look at further overhead resistances." And the next ones are the June 2021 low at 455.90 and the neckline of the April to June reverse head and shoulders continuation pattern, currently at 665.70 and highlighted in dark blue on my daily chart. End of quote. I further added 2 weeks ago the following, and I quote, "I'm unsure about how effective these will be." End of quote. I should not have worried, as between these two the market was capped and prices have dipped lower, but only, as I say, to the 2021 low, though the opportunity now exists for the action since November last year to date to be a possible descending scallop pattern in construction. I'm not sure on this idea, but I would like to put it out there in case we see further declines. I also laid out some ideas 2 weeks ago for this break upwards out of the large bearish pattern. I utilized the idea of a bear channeling pattern as a proxy, and for such a pattern I suggested a primary target X up in the 704.40 area, with a secondary harder to reach target X1 up in the 730.90 area. For now, I will let those targets remain, for now. But given the action over the last 2 weeks, I'm minded to reconsider them next week and every week after. Finally, I would only once again add the following as a postscript to what I've already said. It is something I first said 13 weeks ago, and I quote, "I would add this final thought. I am increasingly becoming interested in knowing if this contract is really an indicator, a leader, if you will, of what the other oil seeds and veg oils may have to deal with." End of quote. To this I added 2 weeks ago, and I quote, and it's important, "This also means on any recovery and move back up, and not only on the way down." Burst Malaysia crude palm oil. If you have listened to any of my commentaries here on palm oil, you would have heard me repeat so many times that the mid-August to early November 2022, that's right, August-November 2022, mildly bearish shift pitchfork, the one still highlighted in dark blue on my daily chart, was running the show here. In January this year, the market rose up to test the upper tine, and then in February and now early March. In mid-January and mid-February, we saw the upper tine, currently at 39.16, breached, but then only with a single close over on each occasion. Not so 4 weeks ago, when we had multiple closes over the upper time, followed by exploitation of the breach turning into a proper break higher, and the end of this venerable bearish shift pitchfork. I was going to retire it after my last commentary, but it so defines this market that I have chosen for now to keep it on. So going back a few steps first, the significant patterns and levels at one time or other within this bearish pitchfork had been the June to September 2023 diamond pattern, the late May 2023 to date uptrend currently at 38.09, and the neckline of the September to November 2023 reverse head and shoulders pattern currently at 40.21. And one that is important right now, and highlighted in bright red, it's the neckline which has just been pierced. The neckline, just looking at it close, neckline currently at 42.21 of the September 2015 to November 2017 head and shoulders top. At one time or other, these and some others that I've chosen to retire have acted as supports or resistances, or now resistances that have become supports, I suppose, which in turn have helped drive prices higher, rising enough that I'm considering them having made a strategic change in the overall longer term bearish perception of this market. In the meantime, today, the market has punched down through the supports that had earlier been resistances of the interesting 38.2% Fibonacci line of the July 2019 to March 22 move, and May to March 22 move at 42.39 and 42.74 respectively, as well as a significant bright red neckline. We are now down far enough that the market is approaching the last of recent supports before we have a free area down to the neckline, currently 40.21 of the September to November 2023 reverse head and shoulders bottom, and the interesting nearby rising short medium moving average, currently at 40.07. Now, this last support is the July 23 high at 41.89. Watch this one carefully. I will leave you with my thoughts from 2 weeks ago, and I quote, "So what now?" Well, for this, I went to my standby on such occasions, the longer term monthly charts, and there was one clear standout level that needed to be watched, and that was the November 2022 high at 44.08. This is a key level on the top side, because it is, if it is broken, properly broken, then there will be a significant number of potentials topside. Similarly, if it holds in that area, then there are significant potentials on the downside. So watch to see if prices reach up to the 44.08 area, and then what prices do at that level. For the moment, we have held off testing 44.08, but we've not had sufficiently big enough move back down as yet to say we are resuming the decline. Continue keeping an eye on the 44.08 level, also the bright red neckline, and what happens at the July 2023 high.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.